So today we're going to talk about the differences between interest rate and APR, which stands for annual percentage rate. I'm not going to go into too much detail about what the interest rate is, but annual percentage rate is the cost of financing over the life of the loan described in an annual rate. And so what that includes is it includes your interest rate plus any discount points, origination fees, and any costs that are part of obtaining the loan. And it is divided over the life of the loan, over the term of the loan. So that way you can see how much this loan is costing you to obtain the loan. So you may have a very low interest rate, but your APR could be significantly higher because there's a lot of cost involved to obtain that loan. So just be aware that when you're shopping loans, the APR is typically the most useful number to look at when you're shopping. But just make sure you're also aware that there is short-term gains to low APR versus long-term gains. And so sometimes there may be higher costs to bring down the rate, which helps over the life of the loan, but short term, there may not be as much gain. So things to keep in mind, compare apples to apples. If you're shopping lenders, look at the loan estimates and talk to the lenders to see what really makes the most sense for you in your situation, long term or short term. If you have any questions, let me know. Stephen Burns, Primary Mortgage Resource.